Well, so friends, we are taking up Sri Loan Product today, and let us understand what this product is, how is this behaving, what are the components of this product, because this is a unique product which you have to understand very well before selling. I'm sharing, let's see. I think it is visible to all of you. Anybody can confirm? Okay. Now say, when a person is taking loan, there is a relationship between the financer and the loanee, or you can say loaner and loanee, because servicing a loan is a long-term commitment for the customer, and it's a planned outflow where unexpected event can derail the plan. So it is very simple to take a loan from any financer or any banker. For any purpose you can take the loan. But the question is, when a loan is taken, this is not for a day, not for a month, it's a long-term commitment. Customer has to repay the loan amount with due interest, and if any unexpected thing happens during this period, that entire planned outflow can be derailed. So loanee has to take precautions, because any unexpected event can take place. For example, accident, critical illness, damage to home, loss of job. These things are beyond control of anybody. And when these things happens, the results could be horrible. Say for example, in an accident, a person can lose his body parts and even can die. If the person has suffered critical illness, he may suffer disability also. If there is a damage to his home, his earnings may be reduced. If he has lost the job, certainly he is not in a position to repay the loan amount. What will happen? If this is the scenario, what will happen? The financer will declare him as a loan defaulter. And due to this, the financer's NPA will increase, because the customer is not repaying the installment. Financer has lost the original loan money plus earnings by way of interest. If both are not received, his NPA will increase. And this is a long-term commitment. Till the customer is not repaying, the NPA will keep on increasing. So it is always better to have some kind of protection, so that this planned outflows should not be derailed. Now when we say bankers or financiers NPA will increase, what does that mean? What is NPA? Let's try to understand what is NPA. NPA expands to non-performing assets. Non-performing assets. RBI says non-performing assets in India is if the loan that is overdue for more than 90 days. Means the loanee failed to repay 3 continuous installments monthly. 3 monthly installments continuously. In that case, it will become non-performing assets to the bankers or to the financiers. So an asset becomes non-performing when it ceases to generate income for the bank. If the banker or financier is not earning out of this loaned amount, income has ceased, it means this is a non-performing asset for them. Because a loan is classified as a non-performing asset when it is not being repaid by the borrower. In such a case, the loan is considered as in arrears. In arrears, because nothing is coming out of it right now. This is in arrears. So, it's to protect such a situation, we have come out with a policy called Loan Protection or Sri Loan Protect. How this protects? When a loanee is taking a loan, he has taken a liability. Now he wants to be liability free. If a financier has given the loan, financier wants earning over it. Financier never will like to increase his NPA. Financier will always prefer that he should have a satisfied customer who is continuously paying the installments and bank is earning the additional fee, that is interest. And loanee would always prefer that there should not be any reduction of his savings. He needs peace of mind. Something should be there that can support him in case of any emergency. So loanee as well as financier both needs some kind of protection where the loan repayment should continue. So this is a product which is a blended combo. Loan Protect policy is a blended combo. It's secure loan plus secure loan and provides gateway to peace. So it's a called blended combo. How it works like that? What are the unique product propositions? This one policy has the number of coverages under its umbrella like personal accident or permanent total disability coverage, critical illness coverage, loss of job or loss of earning coverage. If these things are protected, obviously there will be peace of mind. Because the critical illness coverage will provide fixed sum assured benefit. No medical required till the age of 40. So PA plus critical illness plus loss of job are the part of the coverage. And when the loan is given, loanee's risk cover should be there. A comprehensive protection is required for the financier. So what is the product construct of this policy say? See, this policy can be given to any Indian citizen, financial institution or bank. Indian citizen who could be a loanee, financial institution or bank could be loaners or financiers. Age limit, minimum age limit required is 18 years. Means a person who is minor or below the age of 18 years cannot be given this policy, and a person of maximum 65 years can take this policy. Duration of coverage. This policy is available in 3 durations. That means for 1 year, 2 years, and 3 years. This is absolutely choice of the customer to opt a product maybe for 1 year, for 2 years, or for 3 years. There is no compulsion. If he is taking the policy for 3 years, he has to pay 3 years premium. If he is taking for 1 year, he has to pay 1 year's premium. So cover can be given up to the sum insured of 3 crores. Or brancher doesn't have that much of power, they can refer the proposal to the underwriter and he will grant the permission. So the product construction is very simple because any Indian citizen or financial institution or banker can take it. Age limit is 18 to 65. Period of coverage is 1 year, 2 years and 3 years. Now what are the risks included in the policy? Risks included in the policy. So the policy provides 2 different plans, Plan A and Plan B. Now the good thing is, in both the plans, the risk covered is same. Means personal accident and child care allowance, loss of employment, loss of earning. Loss of earning relate to the professionals who are individual professionals or business people. Say for example, CA, doctor, advocates, they are professionals. Business people means there could be a firm, business firm, industry. So the owner is a business person. And third category is critical illness. So 3 types of different coverages are available under this policy: personal accident and child care allowance, loss of employment and loss of earning, and critical illness. These 3 different coverages are there. In both the plans, these are there. Plan A and Plan B. Selection of plan, either A or B, will absolutely depends upon the customer. Which plan does he want? Because according to plan, the risk coverage he will get. While the policy will provide coverage against the personal accident and child care allowance, loss of employment or loss of earnings, and critical illness. So basically, what is the difference between Plan A and Plan B? That you have to understand. Plan A says for PA and child care, total loan amount at the inception is covered. Listen again. Plan A says in case of personal accident and child care allowance, total loan amount at the inception is covered. That means Plan A can be given when the loan is given. So it will protect the loan from the inception date. What is different to Plan B? Plan B says personal accident and child care allowance is covered only for the outstanding loan amount. Now for another category of risk, loss of employment and loss of earning. Plan A says maximum of 3 years, 3 EMIs we will pay. Plan B also says maximum of 3 EMIs we will pay. But in critical illness, Plan A says total loan amount at the inception is covered, while Plan B says outstanding loan amount is covered. Now I can guarantee none of you have understood what is the difference between Plan A and Plan B. So let us try to understand what is the basic difference between Plan A and Plan B, because both are covering the same category of risk. Then what is the difference? Difference is Plan A is given when the loan is given. Means when Plan A starts when the loan starts. So this is covering the entire risk of the loan amount. But plan B is given when the loan has already started. Maybe some 4 months before, 6 months before, like that. Say suppose I have taken a loan from the bank of 10 lakh rupees. Now at that time I have not taken the loan protect policy. But after 5 months I planned that I should take a personal accident and child care allowance. A loan protect policy that will cover personal accident and child care, loss of employment and critical illness. So if I am taking this policy after 5 months from the commencement of my loan, in that case I can take only plan B and not A. Because plan B will cover only the outstanding loan amount, not from the inception. Maybe in 5 months I have paid the 50,000 rupees per month installment, 2,50,000 is already paid. So for remaining 7,50,000 I would need the coverage B. If I want to cover all the entire amount of 10 lakh rupees, in that case I need a plan A. But plan A will not be given to me because loan disbursement took place before 5 months. 5 months have already gone. So this is the basic difference, because in plan A the risk is covered from the date of inception, but in plan B the risk is covered, that is outstanding loan amount is covered from the date of taking the policy. In plan A, from date of taking the loan. In plan B, from the date of taking the policy. Because the benefit payable under the category 2, that is loss of employment and loss of earning, is similar under both the plans. That is maximum of 3 MIs per year. But it is different in third category, that is critical illness. Because critical illness says the loan, total loan amount at the inception will be covered under plan A. But only in plan B, outstanding loan amount is covered and not the amount since beginning. So I repeat again, there are 3 risks under the policy covered under the both the 2 plans, plan A and plan B. 3 risk categories are same, but plans are not same. Plan A will cover the risk of loan from the date of inception, when the loan was taken. At the same time, the loanee had to take a policy. But plan B will cover the loanee for the remaining or for the outstanding loan amount. Outstanding loan amount, say after 5 months or 4 months or 6 months, whenever he is taking policy. So this loanee will not have the privilege to cover the risk from the date of inception. Here the risk will be covered only from the outstanding loan amount date. Similar is the case of category B, where the loss of employment or loss of earning is covered. Maximum of 3 EMI per year will be payable under both the plans, but in critical illness, total loan amount at the inception is covered in plan A only. In plan B, outstanding loan amount is covered. Am I able to clear the doubt, or you are still in confusion? Because this plan A and plan B are important to understand, then only you will be able to sell the policy to the customers. You have to clarify it to your customer, whoever you are giving the policy, that there are 3 risk factors covered under this policy, which are personal accident and child care allowance, secondly loss of employment or loss of earnings, and third is critical illness. But if you have not taken so far the loan and now you are taking, from the day of taking the loan we will cover the risk. But if you have already taken the loan, 4 or 5 months have already gone, still you can take this policy and we will cover the risk of your loan for the outstanding loan amount only. So this is the basic difference between plan A and plan B, and this is good difference because that authorizes you, even you can give this policy to that person who has taken the loan some 5-6 months ago. Still you can protect him. So these are the two plans. Now let us come to Shri Loan Protect will cover Shri critical illness. But under what circumstances? If the first diagnosis of the illness was during the policy period, or if the loanee or the insured is undergoing for the first time of the following surgical procedures, and occurrence for the first time of the medical events has taken place, because pre-existing disease will not be covered under the critical illness section. So this section will cover different 10 type of illnesses, but the only condition is that the first diagnosis should be during the policy period. Personal accident and child care allowance says that the death of the insured person on account of an accident is covered. Permanent total disablement on account of an accident resulting in inability to remain gainfully employed is covered. Child care allowance are allowable only if the schedule shows insured persons opted for it, and the allowance will be payable to dependent children for continuing their education, limited to first 2 children below the age of 21 years. This clause is important because this education allowance will be paid in case of the death of insured or even the permanent total disability of the insured, but the dependent children should not be more than 2 and the eldest one should not be more than 21 years of age. And only 2 children will be covered under the policy. Both will be entitled to get this benefit. Then comes the loss of job or loss of earning. How it is different? Loss of job is different and loss of earning is different, because loss of employment or loss of job means the person or the loanee is an employee. He may be working with the private sector or government sector. He may be working with a micro industry or a small industry or corporate. So loss of employment means employer rules and regulations have permitted him not to continue his job because there could be a closure of division, closure of department on account of poor financial health. Secondly, termination or dismissal or layoff or temporary suspension or retrenchment of the insured from the employment. If the insured employee has been terminated, dismissed, layoff, temporarily suspended, retrench, all these risks are covered under the loss of employment. And in case of loss of earnings, if the insured or the loanee is not in a position to move from that place, or the person is not in a position to actively do a job, or loss or damage to workplace due to the fire and other perils, or due to inability to access the working place. If the person is not in a position to move, he is suffering with a serious illness, he is not is in a situation to move, plus due to inability to access working place, he is not in a position to reach to his working place. So in the first category, loss of employment, there will be loss of job. The second category, loss of earnings. That means he is a chartered accountant, a professional, a loaner even. Under these circumstances only, he will lose his earnings. But if he is out of employment, in that case also he will lose his earnings. loses his income and he is not in a position to repay the loan. So what will happen? Say suppose critical illness is covered under the policy. Now how we will consider it? First of all, any individual who falls below the age of 40 is eligible for maximum sum assured. Even to the person of more than 40, you can give the policy up to 65 years. But the sum insured of this critical illness section would depend upon the age. And age will restrict the maximum sum insured of this section. Because for the higher age band, the sum insured would be lesser. Say for example, for a person of 40 to 45 years, company will allow sum insured of 50 lakh. 60 to 58 persons, company will not give the policy for more than 25 lakh. For the person of the age of 51 to 55, company will not give the policy for more than 10 lakh. So this is again a good sign that policy, the premium is charged according to the age band, and lower is the age band, higher is the sum insured. Restricted maximum sum insured for higher age band is there. As one thing is important, persons aged at 40 years and above are subject to pre-medical examination. The company will reimburse 50% of this total of such reimbursement. Expenses if the proposal is ascertained. It means here you have to confirm that whenever you are giving the section critical illness to any person, the sum insured limit would be according to his age band, and maximum is 50 lakh rupees, minimum is 10 lakh rupees. And critical illness in India is curable because the treatment facilities are there. Curable and good results are there. Incidence rate is 25%, while the survival rate is 76%. So we are not hesitant to cover this risk, and critical illness is covered. For 10 major critical illnesses we are covering under this policy. Need for to cover that page on survival. Why? Because survival post a critical illness impact on the following ways. Patient has to dip into his savings because he has incurred already the treatment expenses. The earning capacity of the patient reduces. People often believe that the life insurance cover would suffice their need, but life insurance is paying the money only under two circumstances: when the policy is mature or the person has died. So both these situations are not there. Person is suffering from the critical illness. Under that situation, the life insurance policy will not pay. So this policy is required. It is imperative that the customer covers himself against critical illness cover. Then only he would be able to repay his loan. What are the critical illnesses? 10 critical illnesses are covered under this policy. I just read out for the sake of your knowledge what these 10 critical illnesses are there. Cancer of specified severity, myocardial infarction, first heart attack of specific severity. Open chest CABG. CABG means coronary artery bypass grafting. In short, what you call is bypass surgery. Open chest CABG, coronary artery bypass grafting. Open heart replacement or repair of heart valves. Kidney failure requiring regular dialysis. Stroke resulting in permanent symptoms. Major organ or bone marrow transplant. Permanent paralysis of limbs. Multiple sclerosis with persisting systems, and primary idiopathic pulmonary hypertension. These are the name of 10 critical illnesses which are covered under our policy. I don't say you remember these names. These are just for your knowledge. Our policy is covering 10 critical illnesses, and these are those 10 critical illnesses which are covered. Any is suffered by the loanee or the insured, insurance company will pay his 3 installments of the loan. So this is the coverage under the policy for the critical illness. Now, Section 2, personal accident. In personal accident, we are providing the accidental death coverage and permanent total disability coverage. The permanent total disability coverage could be due to many reasons. But the nominee or the insured himself will get 100% compensation. In case of accidental death, because the insured himself is not there, so the nominee will get. But in case of permanent total disability, because he is surviving, so the claim will be paid to himself only. This permanent disability could be in different combinations. How? Suppose in any accident, person has lost both the eyes, both the hands, both the legs, one eye, one hand, one eye, one leg, one hand, one leg. So these kind of different combinations are covered under the 100% permanent total disability category. You know, sometimes there could be more than 100% permanent total disability. Say for example, one person severely met with an accident, and he lost his one eye, one hand and one leg. So as per medical report, he is suffering with permanent total disability, that is 150%. This could also happen. But for 100% and more than 100%, company will pay the total sum insured of this section. Either it is accidental death or it is a permanent total disability. If during the policy period, insured person named in the schedule meet with any accident or bodily injury that cause his death or permanent total disability, in that case, this policy will pay 100% compensation of this section. Now, when you are giving the personal accident coverage, the premium will be charged based on the risk category. And risk category under the personal accident policy is decided by 3 factors, 3 groups, wherein you will find low risk group is there, medium risk group is there, heavy risk group is there. So in risk group 1, those persons or professionals are included who are having the least risk, because they are working at a very safe place, they are having bilkul accident free zone. Say for example, accountant, doctors, lawyers, architects, consulting engineers, teachers, bankers, or persons of administrative field side. They are working in a safe place. So the chances of accidents are very rare. They comes under the risk group 1, that is called low risk group. Here the premium will be lesser. Second risk group is medium risk group. Here the risk is slightly higher, because the persons of this group are working in the field. So the chances of accident in the field are higher. Say for example, builder, contractors, veterinary doctors, drivers, cash carrying employees, woodworkers, sportsmen, athletes, They are always in the field. So their risk category is group 2. They are under the medium risk group, and here the premium will be slightly higher. Third group is heavy risk. Here the persons working in underground mines, explosive mines, involved in electrical installations with high tension supply, jockey, circus personnel, big game hunters, mountaineers, winter sports players, skiing players, ice hockey players, hang gliders, river rafters, polo players. These are the persons who are engaged in most risky jobs and professions. They could die at any moment because of their job or profession. So they are having the very heavy risk. This is called risk group 3. So here obviously the premium rate will be high. So according to these 3 groups, the premium rate of the personal accident section will be applicable. But PS section doesn't include the pre-existing disability, death due to mental disorder, death by radiation, infection, poisoning. These are not accidents. Intentional self-injury, suicide, or attempted suicide, they will be accidents. Now this same section also includes child care allowance. Child care allowance means if the insured has died in an accident or the insured has suffered the permanent total disability, in that case this section provides payment of allowance, child care allowance, to the dependent children up to the limit of the sum insured as specified in the schedule. And this could be 2% of the sum insured. But the children should not be more than 21 years of age. Allowance will be payable to the independent children only, dependent children only, dependent on the insured. If the insured has died and suffered permanent total disability and his children are below the age of 21 years, only first two. In that case, policy will pay 2% of the sum insured under this section. Third is loss of employment. Now, loss of employment means company will pay 3 MIs if the insured has lost the job. But loss of job because of what reason? How has he lost the job? Maximum 3 MIs towards a lower amount or lesser specified in the amount will be paid by the company. If the insured has lost the job because of the termination or his firm is closed where he was working, or that has been merged or acquired, or the employees have been laid off, temporarily suspended, retrenched by the employer, or the employer has launched any retirement scheme of the compulsory nature, compulsory retirement scheme. If the compulsory retirement scheme is there, then only one person will not be retired. Some 15, 20 will be retired. So if the action is from the side of employer, maybe of termination, dismissal, layoff, temporary suspension, retrenchment, compulsory retirement scheme, in that case only this will be treated as loss of job or loss of employment. If the employee himself has resigned he has opted superannuation or early retirement. In that case, this will not be treated as loss of job. The insurer will not pay anything. Because he has not lost the job. He himself has resigned. He has opted superannuation. Employer has not forced him to leave the job. This will not be treated as loss of employment. Another category is loss of earning. Loss of earning means if the person is not an employee, he is a professional or a business person. But he is not in a position to move because of any serious injury or because of any serious illness, or he has suffered a loss of damage to the working place due to fire and riot perils, or due to inability to access to the working place. Some road is cut, area is under curfew, flood is there. He is not able to reach to his working place due to operation of act of God peril. Some earthquake is there. In that case also he can suffer the losses. So here the loss of earning would means under these circumstances, if he has not earned, he has suffered the losses, in that case the company will pay 3 EMI towards loan amount. Now how you can sell this policy? This is interesting to understand. This is called customer onboarding and process outlay. Here you will see the loan process of a financier or a banker is very simple. What they do? First of all, a customer applies for the loan from the housing finance society company or bank or to any financial institution. That financial institution, credit team will inspect the documents, verify everything and will sanction the loan if everything is found satisfactory. Because document verification, person's source of earning, all these things are examined before the processing of the loan documents. Once the loan is sanctioned, then the sales team of that financial company goes to the customer for docket signing with sales team. Docket means loan related papers will be signed by the loanee. If at that time, when the loanee is signing the docket, because a loan amount has been sanctioned to him, if at that time our proposal form is there with the financier, with the bank or with the institution, he will also get the same proposal form signed by the customer, because this Sri Loan Protect proposal form is given to those financiers, to those financial institutions. When they are sanctioning the loan, they are disbursing the loan, at the same time he will also get the proposal form signed. Once it is signed, the bank or the financial institution will start deducting the premium amount from the installment or loan amounts. Because the customer has already agreed, he has signed the paper. So when the loan is disbursed with insurance premium, the banker or the financier will remit the insurance premium amount to the insurance company and will retain his own interest or loan amount or repayment amount with the banks. So what is the important thing is when the docket is signed by the loanee, at that time only the proposal form must be there with the financier. He can get the proposal form signed by the loanee and the policy will be issued. Claim process is very simple. If there is any claim is there, under any of these 3 categories, claim is reported to the insurance company. Insurance company will get the claim settled and will repay to the financier, because the outstanding loan amount is there. The payment of the sum insured amount in case of claim against the PA category or diagnosis of any 10 major critical illness or loss of job will be settled by the insurance company. Now, value for money rates so as to put minimum burden of insurance premium on the client's regular EMIs. This policy value for money rates because the insured or the loanee is under the minimum burden. A regular revenue model for the finance company is there, whereby they are financing and getting that finance insured. This policy keeps the insured and his family as well as the financer worry free from the calamities on the assets and survival of the insured. Even if the insured has died, still the financer will get at least 3 installments. So our robust IT system allows regular flow of policy issuance and MIS because IT driven fast claim intimation and settlement process is there with us. Now why your company selected? The customer may say, why should I take from it? In that case, we have to highlight few factors. We are a renowned name and brand with a proven track record across the insurance industry. We provide SMS facility for sending policy, renewal, reminder, or the claim status. Business figures are sent to the channel partners via automail on daily basis. All MIS via automated email system at predetermined frequency to channel partners. Partners are converted to MS Excel format for analysis. Business done by branch, product wise and relationship managers wise breakup. That is also given on monthly basis, on daily basis rather. And the one more biggest factor is that we have a largest branch network and the biggest sales force also. So these are our unique features which increases our sale. Customer will check everything of them. Infrastructure support, our national coordinator dedicated to handle the relationship will provide state-wise dedicated manpower for business support. Matrix support structure involving local branch. Flat structure, no claim file travels more than 2 hands. Claim will be settled immediately. Now one good thing for you is, we have got tie-up with these companies who are the financiers. You can give your proposal form to them. Awas Housing Finance, Hinduja Leyland Housing Finance, India Home Loans, DMI Housing Finance, Sriram Housing Finance, Supreme Housing Finance, Indexia Home Finance. This list keep on changing. Some additional names are also there. Some may be dropped. But this kind of list is already there. You can give your proposal form to them so that at the time of disbursing the loan, when they are getting their docket signed, they will also get this proposal form signed. So the financer will play a lead role in promoting your Shield Loan Protect business. Now how the premium will be charged? The basic conduct for charging the premium is basic rate into sum insured minus discount. So for example, the personal accident premium we have to charge. So the criteria of charging the premium of personal accident is risk group basis. Risk group 1, risk group 2, risk group 3. Rate per PAs per milli per thousand. Risk group 1, that is lowest, low risk group 0.70 per thousand. Risk group 2, that is medium risk 0.95 per thousand. Risk group 3, that is heavy risk 1.40 per milli. For giving the loss of job section, the chargeable premium is rupees 50 per milli to be charged on EMI. Rupees 50 per milli to be charged on EMI. And for the critical illness, the rate is charged according to the age band. 18 to 15, lowest premium rate 1.83, because the persons of 18 to 25 do not suffer the critical illnesses normally, 99.9%. The moment the age is increasing, the chances of suffering the critical illnesses are greater. So 26 to 30 it is 2.31, 31 to 35 it is 2.80, and it goes in the same manner up to the age of 70 years, that is 144.63 per thousand. Though the difference is very high, because the premium rate chargeable for the person of 56 to 60 is only 28.93. But the crossing the age limit of 60, then the person becomes a senior citizen, the rate is just doubled. So higher is the age, higher is the premium. Lower is the age, lower is the premium of critical illness. Now there is a provision of discount also. If a group is taking this policy, group of loanees, group of financiers, so for less than 200, 2% discount can be given. 200 1 to 300, 4%, 300 1 to 456%, and above the age limit of 458% discount can be given. Discount criteria as per the policy tenure: 1 year, no discount; 2 years, 3%; 3 years, 6%. So this discount you can offer to your customer whenever you are giving this policy. Now, any individual who took plan will be the target customer. Any individual who is taking loan from bank or financier is a target customer, and you can give him the policy, because this is to protect the loan amount. This policy can be sold through financial institutions like bank, NBFC, who are authorized and have the license to disburse loan. Or customers who avail long-term dwelling insurance can be potential customer for this policy. Long-term dwelling insurance means policy for the residential houses. Long-term policy. He can also take the C-loan protect policy. The premium calculation is basic rate into sum insured minus discount. Policy can be sold through financial institutions and to any individual who took the loan. This is the simple Sri loan protect policy, where basically 3 categories of risk are covered. 2 plans are there. One plan is you have to pay when the loan account starts, means from the date of inception only. Plan B you have to give for the outstanding loan amount, means the loan has already started, but today after 4 months or 6 months we are giving the policy. In that case, plan B will apply. But the risk coverage under both the plans will be similar. The policy is more sellable because this is a policy which is covering the risk of loss of job also. You will not find such kind of policies in the market where the loss of job or loss of earning section is also covered under any of the single or the group policies. This is a rare policy from that point of view.